Are all your eggs in one basket? They just might be without you realizing. Find out more coming up. Hey folks, I'm Patrick King with Transformative Financial. Here on this channel, we help people make money, keep money, and feel more financially secure along the way. If that sounds like something that you would be interested in, I would love to talk with you and see if it's a good fit. My email is patrick@transformative-financial.com. My phone number is 404-500-9261. But on today's episode, do you have your eggs in one basket without even realizing? Kind of when I looked into the origins of that phrase, don't put all your eggs in one basket. It's something that we all kind of intuitively know. We don't really know what the origins were. It goes back even to the 17th century. Some people credit Cervantes and Don Quixote with the origin of that. But I came across an old German phrase that I liked even more, and it goes something like, make sure that you have enough legs to stand on. And when it comes to your investments, I think that's probably an even better phrase to use. I think, the way that I think about how to structure investments and reduce the risk of your investments, your total portfolio. So when you think about putting all your eggs in one basket, if you've been around investing at all, you know that this is something about diversification. It's really the only free lunch in investing. So instead of putting all your money into one stock, you certainly want to spread it out to take the risk away from whatever happens to that one company. So if you think about companies out there that are on the stock market, everybody has to deal with economic and market risk, right? Every company out there. But each company has a specific risks that they have to deal with on a day-to-day basis that may make their stock do something different, positive or negative, than the market in general, right? So what you want to do is, obviously, by investing in a basket of companies, reduce the risk associated with what could go wrong with one particular stock. So this is something that's very intuitive, and we all kind of know this. Just intuitively. So what drives folks there? And there are a lot of us out there, and I've certainly done it in the past, where before I became advisor, where we invest in one stock. Why would you want to do that? It's a temptation, right? Because all of the information, well, maybe not all, but like a large majority of the information about these companies is out there. It's publicly available. Thanks to the internet, we can find out just about anything about publicly traded companies in real time. Number two, I think, and this is maybe more of a reason, is that we have familiarity with a lot of these companies, and we want to say, hey, I use their products every day. I'm a big fan. I'm a big believer. I want to make an investment in that company. And so that brings me to the final point is, often folks confuse a good company or a good product with a good investment. And they're not necessarily the same thing in a lot of cases. Today, things that are coming up, when I talk to folks a lot recently are, an example would be Tesla. Tesla, especially with my engineering background, I'm very, very impressed with the Model S. And I think the electric car, you've got 100% of the torque 100% of the time, fewer moving parts. I think eventually, once the battery densities start to come up, you'll see more and more successful electric cars out there. But the question about the investment side of Tesla is a completely different question, right? Right now, they're struggling with some operation issues. Getting the Model S out on time. They've got a lot of promises. They've got some, potentially some quality issues that they have to deal with, and then they've got some investor issues too. They're trying to raise more debt financing for the company. So great product, perhaps not the greatest investment at this point. Whether they survive or not, is yet to be seen. I'm not saying don't have any investment in Tesla, but you certainly don't want to go all in right now. The flip side to that would be a company like Amazon. Amazon's doing really well right now. Unfortunately, they're dealing with other problems like the president tweeting and their share price going down on the same day, obviously referring to President Trump's tweets about Amazon. So, as an investor, okay, yes, it's a very appealing company right now, but there are also issues out there that maybe beyond the company's control, beyond the investor's control, that could potentially lower the value. And just to kind of put this issue in perspective, years gone by, you look at the good product versus good investment. I think that think back, I banked at Wachovia. Investing in Wachovia would have been a bad idea. I loved Circuit City when they still existed. Bad investment idea. I owned a Nokia telephone. I guess Nokia is still around, but they're not in the game like they were, right? So, like those are great examples of just because you're a believer and just because it seems like there's no reason these companies shouldn't exist into perpetuity, that you should go all in with their stocks, right, as an investment, as part of your portfolio. So, of course, there are times when you can't get around having an individual stock in some sort of significant fashion in your portfolio. And great examples of these would be folks who have an employer stock purchase program where you can buy your employer stock at a discount, or if you're a C-level executive and you have a minimum share requirement of the company that you're working for. And then, of course, you're blocked out on certain dates where you can make transactions on that stock. So when you'll run into those issues, or let's say you've got old stock with a ton of appreciation in it, you don't want to sell it all and get a big capital gains tax bill, right? We want to have a plan for that. But in those cases, what I normally do is I recommend, hey, we make a plan and we limit the exposure to that one particular company to less than 5% of your entire portfolio. Once it gets above 5%, it's a concentrated position is the term that we have for it. It's a abnormally large exposure to one company in your portfolio. So 5% is the max that where I start to get uncomfortable if it goes over that number in a client's portfolio. So the key takeaway here, every company has to deal with market risk, economic risk, but with diversification, you don't have to take those risks. You can take the market risk and economic risk and get paid for that over time. Over quarter by quarter, obviously it's going to vary. But you don't have to take the risks that are involved by investing in just one company or just 3 or 4 different companies. That's what I got for today, folks. If you want to learn more about diversification, there are plenty of resources out there. I'll post links in the show notes. If you like this video, click like. Of course, subscribe if you want to have more of this kind of content. Again, my name is Patrick King with Transformative Financial. Thank you for watching, and until next time, cheers.